Welcome to the Value Builder Podcast, where we focus on real estate with a value-add mindset. Real strategies, real operators, real outcomes. Let's dive in.
Welcome back to the Value Builder Podcast. I'm your host, Solzin Kavicius, and today I have a great conversation with my friend Tim Chen. He and his partner built a company, Connected Companies, a full-service commercial real estate investment firm in LA, and they built portfolio over $150 million in assets. That's multifamily, self-storage, mostly ground-up development, all that within 6 years. And they have really good nuggets to share in this podcast. And Tim's story is incredible. He came to U.S. from China at 19 years old, barely speaking English. He worked his way up through USC, failed a few startups, then broke into commercial real estate as a multifamily broker at CBRE. And in 2019, he went out and bought his first small 5 and 10 unit deal, then eventually 70 unit portfolio in Seattle. And now he's got 180 units under construction and another 400 units pipeline. In this episode, we're going deep on the state of multifamily right now, the pain, the distress, why the rents are not growing, and where the real estate opportunities are right now. Tim will share his playbook on why he pivoted from value add to ground development and how Prop 13 in California, only California gives developers a massive tax advantage, and how he uses that still to maximize that deal and create value. And how he's finding deals of markets from non-traditional sellers like, utility companies, churches, and whatnot. And if you're an operator, going to relate to this a lot. So stay to the end. There are some real gems in here. So let's get into it. I'm looking forward to a great episode. So Tim, welcome to the show.
Thank you for having me, Sal.
All right. So just to start, let's go and talk a little bit quickly about your story. You have a fascinating story. You're a fellow immigrant, and just give us kind of a flavor. Where you at? Where you from? How'd you end up in commercial real estate? Share with us those highs and lows. That's so inspiring. I know the story, but I know many of yours don't. Listeners don't, so please share with us.
Oh, yeah. Definitely there's a lot of lows, right? But of course, we have some highlights too. But a quick story and quick background for me. So I was born and raised in China. I came to the States when I was 19. Been in the States for almost 20 years, but that's how old I am right now.
Mm-hmm.
And so I graduated from USC, undergrad, accounting and a business major. After that, I had this opportunity to work at CBRE as a multifamily broker for 4
Mhm.
years. So 2019, I quit brokerage because the market was great back then. I don't know if you remember, right? So anything you buy, just appreciate. The rent keep going up,
Exactly.
all that. Yeah, and naively enough, I thought that was easy. The investment was pretty easy, right? Just buy and you make money.
Mm-hmm.
So I quit 2019. I quit brokerage, and I started partnering up with Chaplin, which is my partner now. We start buying smaller multifamily, 5 units, 10 units. That's how we started. And the third deal we bought is actually a bigger deal. It's like a 70 unit portfolio in Seattle. We make a lot of money on that one. And
In Seattle?
Yeah, it's a 70 unit portfolio, about $10
And
million.
what year was that?
We closed that. It took us 6 months to negotiate. We closed that May 2021. That would make a lot of money. It was a great deal for us. We got lucky on that deal. Then 2021, 2022, it was crazy because we just keep buying deals. But I think we bought close to 20 deals. Some small, some big. We bought some self-storage too. Then 2022, interest started, going up. It was crazy, and the market just froze. So we started pivot, meaning we don't buy stuff out of state anymore. We came back to the local market. We start doing developments. We buy land. We do entitlement. We start just doing developments locally. We start building the team. Right? We in-house property management, in-house construction. Now we have 3 job sites, 180 units in the pipeline already broke ground. That we're going to finish in about next 24 months. We still have about 400 units in the pipeline we are entitling right now. Right, so that's kind of how we pivot. And the market change again. It's been 3 years, tough markets. So we try to be fully integrated. Right? So we're growing the property management and the construction side of the business right now. So kind of this is where we're at.
Makes sense. This is amazing, man. Thanks for sharing. Now, we've been definitely in multifamily for the later part of your career. Let's talk about multifamily. We have a little conversation when I saw you in Atlanta, but what do you see right now, multifamily? There is a lot of blocks, there's a lot of pain, but what's the play? What's the real truth from an operator on the ground?
Okay, yeah. So I'll give you the first information. So multifamily is an asset type. It's commercial. It is commercial real estate. Whether I mean, even though it's tailored towards like people who live in there, right? But it is considered commercial real estate, and it really depends on the area. You know how it goes, right? In the past 10 years, a lot of social media, people talking about multifamilies, like top on social media, it becomes one of the hottest asset in the past 10 years. So a lot of newcomers coming into this space, right? And the cap rate compressed so much. 2021 and 22 definitely was crazy. I think it depends on the markets. I was in Atlanta meeting with one of the biggest multifamily broker in Atlanta. He told me that a lot of C, B minus, D area, the multifamily basically is underwater, right? He gave me one example where somebody bought it for 250 units. So it's 250,000 per unit 2 years ago. Now they're selling that as $130,000 per unit. It's like 50% off, right? Not only they lose the principal, the down payment, the bank has to suffer loss too, right? It was $17 million loan. Now,
Was
the
it
bank
was
go
it CMBS or that was the regional bank?
regional bank, mostly regional bank, because a lot of people, I think 2021, 2022 interest was very low. A lot of people buy multifamily with 80% debt on it, right? So it has to usually it's regional bank, and also better strategy. But the problem is that the rent did not go up as much, and the occupancy goes down. And a lot of people actually, I know one of my friends, he bought in Macon, Georgia, with a floating rate debt. I think it was like 18 months later, he just lost everything. It was a $10 million deal. He raised about $4 million. 18 months later, he lost everything. Most of our portfolio is in LA area, which is fine because the occupancy and growth is still there. But I know it's not as much right now, right? You can't grow 10% per year. I think in Inland Empire, that's like the east side of LA markets. 2021, I remember the rent growth was 19.6 per year. One of the highest rent growth in the country, right? But it can't continue, yeah. So markets like Phoenix, Texas, they're suffering from the oversupply problem. It's too easy to build and people build too much.
Now, do you see also in these markets rents dropping, actually going down?
Oh yeah, a lot of markets,
Right.
especially tertiary market, for sure.
Yeah.
The market where the rent went up so much, so quickly, and it just come back down very quickly.
Yeah, I wrote an article a couple of weeks ago about rent increases. And so definitely that's that. I think mainly that rents are not increasing, and cap decompression. So let's say I think there was an example that if someone bought like apartments that called mid 4 cap, and right now it's pushing 6, it's because of this decompression. You need to get about 40% more in NOI to get the same value.
So here's the problem, right? If the rent is going down, how do you underwrite a deal? Underwrite a deal, rent trending down? No, right? That's tough.
Before it used to be all right. So you're underwriting that, you're kind of banking that rents are going to increase. At least we'll keep up with inflation.
Yeah, at 35% per year.
But I don't bank that those rates are going to go up.
Yeah.
So the only way to do a value add, you actually have to go steep discount and at the buy price.
Yes.
And it just like, it's writing those 40% off offers. They're not sticking. Obviously, sellers are not accepting. A lot of times they have more debt. They can accept it. But before, you used to put full price offer, right? And as long as you can catch that appreciation, back to market rents, that's it. Right now, I think the way it is, just writing, very, not low offers, but offers that work only if you have a steep discount, then the seller can accept it, which is very rarely. On mine, what I'm doing, I'm meeting more people in distress industry.
Which asset type are you talking about, or just any asset type?
I think all the asset types are feeling the pain. What I'm seeing, I think multifamily probably feeling, most of the pain. I think hospitality, the same thing. Retail is doing probably better. Office kind of, it's still in the shitter. I think, it really still have a lot of pressure. But in multifamily, I think retail is more or less a leader in terms of feeling less pain because of occupancy. I think industrial is still doing pretty good, especially with small bay vacancies. Still sub 5% and big box over 7%. But what I see an opportunity or where acquisition resources should be focused, at least on my end, just rekindling those relationships back with banks, receivers, the foreclosure attorneys, because as you say, a lot of banks have those problems, obviously they're not realizing them. It's a question is if they're going to start going down the pipe, I mean, if they will start realizing, or they're going to keep pushing down, down the road, and if the feds will allow it. So I don't know. I'm not clear about that. If more and more deals will come out from that, because in theory, they have a way not to realize on their books and just keep pushing, and eventually they will work out, right? Eventually, if you have 5-year window, they will work out. So I don't know if someone can hold that much. Yeah. All right. So now back to you. Where do you see an opportunity right now? Talking about value add or development ground up, right?
Yes.
Actually, let's talk about how much is your new ground up and how much is your value add, let's say, in the last 3-4 years.
We haven't bought any value add deals in the past 3 years. It's all developments for a couple of regions though. But this is LA or California specific, right? It might not apply to other region. But I give a few reasons why. First of all, in LA everything is still so expensive, right? People still. Not. I would say people still selling at about like 4.5 to 5.5 cap rate. Over here, interest is like 6 to 6.5. It still doesn't make sense, right? That's the first thing. And people selling and people getting their price right now. So for me to buy that doesn't make any sense, right? But people still getting their price. First reason. Second is that you buy stuff 4.5 to 5.5 cap rate going in. There's rent control in LA. So you do all the value add and 2-3 years, right? You relocate tenants, push the rent, all that, and you're getting a building in the 60s, because in LA, most of the building in the building prior to the 60s. In the 60s, like I would say per cap rate or market cap rate is 6.5 or even less than that, okay, or 6.25. The problem is that I do all that after 3-4 years, I still get an old building with a 6.25% cap rate.
And you did 6 or 6.5. How do you money? Right.
You still don't make money, right? But if I do development, everything we do is kind of on off market basis now, right? So we identify the lot. Usually it's infill lots. There's a structure on it, single family house, retail, or office building, whatever, right? So we buy the lot with the structure on it, and we took it from raw land to RTI ready, right? It's about 2 years in LA, 2 or 3 years in LA, and we control the cost of the lot. That's the first thing. Second is we have our in-house construction teams, in-house framing and concrete, right? So our cost is 5 to 10% lower than other people, right? We control the cost, we control the timeline, we control the quality, so that we can control. And once I finish that, I'm able to hit at least 6.5% cap rate once I finish it. It's about a 4 to 5 year process, right? So I got brand new building, at least 6.5 to 7% cap rate once I finish. The brand new building is very in demand area. I can sell that, I would say 5 to 5.5% cap rate. So I have about 150 to 200 basis, spread over here. So which is good. And another thing is in LA, because there's rent control, but for a brand new building, 15 years there's no rent control, which is great. And also there's a advantage on property tax that probably only apply to LA. So for example, we finished a building in 2020, 60 units apartment building. The market value is probably about $24 million. But we're paying property tax on a $11 million assessed value, because that's the construction cost, right? And as long as I don't sell, the property tax will only go up 2% per year based on $11 million valuation. We're saving $140,000 property tax alone. Translate that into property value, that's about $2.5, $2.6 million valuation, right? So that's LA. We build and we keep it, because our expense ratio is very low. For normal building in LA, expense ratio is 35 to 45%. For our building, it's 27%.
Again, how do you do that? How do you shave off that 10% almost of the
property tax? New building, property tax. Property tax is a big one. But they're only applying in LA. That's why we do construction.
And again, just to go back now, so for how many years the tax, you're getting that the tax incentive or whatever you call it?
For the brand new building that we built, the assessed value is only based on the construction cost.
Okay.
That's very unique in LA. Like our cost, for example, if it costs us $10 million to build, all in costs, including lands, all that, right? And once you finish, let's just say it's worth $15 or $20 million, but the property tax is only based on my $10 million cost. That's it.
When is going to get reassessed?
So they reassess it every single year, but there's Proposition 13 in California, meaning as long as you don't sell, you don't transact, there's no ownership change, they can only go up 2% per year. That's it.
This is okay. This is just the bomb, meaning that
I know.
yeah,
Yeah.
this is just really amazing piece of information.
Let me give you one. Let me give you one particular example. So when I was a broker, I sold a six building in West Covina. It's probably 80 units. So we sold that for $18 million.
Hmm.
The owner owned it for 30 years, and he was paying property tax based on $5 million valuation on it
Wow.
with a $18 million building. Right? Just think about it. That's like, I don't know, 150 savings on property tax alone, right?
So you incentivize very much. That's only in LA,
It's only in California.
but that's
That's why
statewide regulation, or is that only county?
statewide. It's called Proposition 13. You can Google that. So it only applies to all properties in California. That's why in California it's better to hold.
Mm-hmm.
And
Because
that's where the big money is.
right, you're getting different bases on the taxes. That's yeah, that's
Yeah.
okay. So now, but yeah, this is awesome to understand that. Now, help me understand. Then the next group who buys it at 4.5 cap and increased tax bases, and their OPEX right now 35 to 40%. How in the world they able to buy it if the debt is 6?
They can.
But you say that they use it to trade it, right?
Or somebody. So here's the thing with California. Right? A lot of rich people, they don't really buy to make money. They buy to park money. That's the problem.
Just cash transaction, just save
Yeah,
payment.
cash, you're like 50, 60% down, right? So that's the problem. Like we're competing with a lot, like Newport Beach, right? A lot of old money. Like
Mhm.
they don't want to go out of state, right? They don't feel comfortable going out of state, and they don't need to make money, right? They just want to park their money. So we are competing with those people in this particular market. That's why our market is very competitive. But of course, the market is tough now. It's tough to sell deals. People are not buying as much. It is a buyer's market, but still competitive. Yeah.
Every week, I read hundreds of commercial real estate articles from across the U.S. and around the world. I connect the signals, break down the Fed moves, and share real case studies, not theory, from my 2 decades of real estate experience and actively doing deals right now. My team and I spend 15 plus hours on a weekly basis and deliver this to you for free. You can read it in 5 minutes. So every Sunday at 9:07 a.m., you'll get major commercial real estate news that matters, one Fed insights that matters, one deep dive case study from me or one of our operators who already made the mistakes, so you don't have to. Thousands of commercial real estate operators and investors read this newsletter, especially in the value add space. And don't take my word for it. Check out hundreds of reader testimonials online. Plus, when you subscribe, you get instant access to a Perform underwriting tool, the same one we use every single day to underwrite value add deals. Now, this is not for you if you're looking to get rich quick schemes, or if you're looking for theory and hallucinations, not real numbers, or you're not serious about commercial real estate. But if you want real tactics, real deals, real results, no bait and switch, go to joinvaluebuilder.com and subscribe for free. And see you there, guys. All right. This is great education for me, myself, and for all the other listeners about California. That's those, like they say, the devil is always in the details, right? This is a small detail, which is, wow, if you can shave off 10% of OPEX,
So for you, right, your idea or your strategy might be buying a stuff, buying a infill area land in California and build some mobile industry and just keep it forever, right?
right? Exactly.
Something like that. Yeah.
Because it applies not only to multifamily, it applies to any
All real estate. Only real estate, yeah.
So that's why you hold. Okay, gotcha. Are there any tricks that say that you sell beneficiary interest in an LLC in a trust and it doesn't trigger, or let's say if you still?
So any ownership change, even just 0.1% will trigger reassessment to the market value. So try not to do it. Or talk to your attorney or talk to title guy before you do that. Yeah. So I made a mistake on that. Where like my parents tried to for example, the property was under my dad's name, personal name 100%, then transferred to a LLC 50-50, right? My parents own it. Then it triggered reassessment. I lost I don't know, $10,000-$20,000.
Now, where do you see an opportunity right now in real estate? We chatted a little bit before that you still have to, figure out how to grow the business. You mentioned about going vertically, but where do you see yourself? You can unpack, where do you see yourself right now in this environment, higher debt environment, high cap rates, not enough rent growth? Where do you see the opportunity?
I think the opportunity for me, there's a couple of things, right? One, for the investment side, I do think there's still deals out there, but it takes longer to negotiate. There's more here. For example, deals that are expired, right? We're calling those deals just expired, or it was on the market multiple times, right? Didn't sell, and we talk to them, we grind them down, and after 6 months, a year, hopefully, they will cater for it. There's still disconnect between the buyer and the seller, but it takes time for the seller to realize that the market is not 3-4 years ago. So those deals, I talked to a lot of friends. I think the best deals in today's market is those deals who were listed multiple times, who did not sell, who have to sell, but you keep following up. That's the good deals in today's market. Yeah. So
And so you're still chasing the traditional sellers who just were too long in the market, not necessarily distressed, right? But looking for those sellers.
not necessarily distressed. Because in every area, I don't know about other state market, but in area, not too many distressed, properties. But there is properties like way, below the market. There are some deals like that. Here's what I think: whoever listed or whoever sell in today's market, they probably have to sell. Otherwise, why would you even sell, right? This is very, 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 it's very bad market. Why would you even sell? So if they listed, if they want to sell, that means that most likely they have to sell. They just need time to realize, they just need to take a haircut on their price. Yeah.
Yeah. So coming back to distress, I don't see a lot of distress from the traditional market or from the brokers. The only information what I see is from research that, let's say, CMBS market on distress level, office side, it's pretty much comparable to savings and loans levels. They just not pushing that out. So that's the question: if can be some of the deals done up just directly going to the banks, which actually I'm meeting some of the banks. Yeah, but in terms of offers, I'm looking at my pipeline. Yeah, I don't even know what the number is, but probably, over 50 LOIs out to get one accepted just because we're asking so much off from the asking price.
Yeah. And there's another opportunity that we are seeing right now. So there's a lot of not traditional sellers. So to give you one example, like church, right? School, public utility companies. They are not money driven, right? So we bought 2 lots from water company. Great deals. The only reason they own about 2,000-3,000 lots around the country, right? The only reason they sell because of it's for the tax purpose. So for us, we are building connections with those sellers through brokers now, right? Where they are not money driven, they are not traditional sellers, and they're selling them for different reasons. The way they value the property and the way that other investors value the property might be different. So there's I wouldn't say mispriced. So there's I think disagreement on the price that we want to put on it, and and they can take. So we see the opportunity. We bought 2 lots from water companies right now through a broker, and I think it's a great deal for us. Yeah.
And that deal flow is mainly coming through the brokers, or you are cultivating a relationship with the sellers yourself?
Okay. Let me give you one example how I bought it. Okay. So we closed first deal, then we prove ourselves. Then the second deal, they just then we start building a relationship with the broker by closing the first deal. Then the second deal becomes a lot easier. So the way we do it, so there's a water company lot next to our lot. Of course, it's a PO box. I don't know who it is. It's big corporation, right? Steel corporation. So what we did was, I have a guy go into their office. It's just like a corporate office, local regional office. We give them a handwritten letter saying we want to buy their lot. So I don't know what's going on, right? In the back. I think it was like 9 months or a year later, somebody from CBI called me, said, "Hey, Tim, water company told me to call you." That's how I got the first deal.
Yeah, totally hands down. I agree with that. Guerrilla marketing and old school works. My record, I bought a property from a letter I sent 7 years ago. And somehow people, sometimes they keep those letters.
Yeah, right.
They keep those letters. I know they bought it 7 years ago from a letter I sent. And sometimes, it's mind-boggling, but definitely it works. Coming back to this market, I'm trying also to cultivate those relationships. Tomorrow I have a lunch with one local municipality planner, and I'm just putting my calendar every single week. I would say 3 to 4 appointments to meet with people just outside of traditional brokers, but, with attorneys, bankers, and even now city planner developer, to see if there's something we can take it off their hands, because as you say, they're not necessarily looking at that valuation like we investors look at basis and NOI, and we just can't. We anchored at that Disneyland pricing, right? 21, 22, and we're just like, how can I sell this at this price? But they're not.
So I think in today's market, it's very important to get creative on the pipeline, right? Before we would buy deals from brokers. Now, we're going to get creative. Attorney, CPA, whatever, not traditional way of getting deal pipeline right now. Yeah. And the third opportunity that I see is the service-based business, right? So I think last time in Atlanta we talked about that. In the past 2 years we're focusing on growing the property management and also construction side of the business to generate more cash flow, which makes sense. So not only we generate more cash flow, but we use this tool to feed us on the deal side. For construction side, in LA, there's a lot of distress. So we want to see if we can take on some RTI ready law, right? No internal risk, we can just build it, right? Because a lot of developers, they've gone through a very long way to get their law entitled, but now they're tired. To give you one example, there's a law in Pasadena where I was negotiating. The owner bought it in 2017. He thought it can take just 2 years, to entitle it, and he can just start building. After 10 years, he just got his. The city was tough to deal with. After 10 years, he just got his plan approved, RTI ready now. But it's been 10 years. He's old. He doesn't want to deal with it anymore, right? He's thinking about selling. So those kind of deals, happen in today's market. So it takes time to negotiate, but I do see opportunity on that.
How big is your property management company right now?
Let me see. Between the capital side and property management company, we have about 27 people, 17 in the Philippines. There's some overlap. Property management company probably like six to seven people. We manage about 300 units locally. 6 to 7 people. We can take on probably another like 200-300 units without adding more staff.
So it's a hybrid between local and outsourced in the Philippines, right?
So Philippines, 17 people we hire directly, and we've been using them for 4 years. It took us, some time to build a team, but once you build it, stabilize it, it's great.
Yeah. The team in Philippines, what are responsible for collections, maintenance calls? What they typically do
in the Philippines? Oh yeah, so they do bookkeeping. We use a Folio, right? The software, management software. So bookkeeping, they handle the software. What else they handle? They handle the costs. That's pretty much it.
Leasing? Are they doing leasing?
Yeah. So they will help with the leasing, right? So for example, typically when somebody come, they go to our website. They schedule the appointment on the back end, right? They can take calls too. And I think the only thing that local, we have 3-4 people locally, is the repair maintenance, and the overseeing them. And also sometimes, there's emergency, you still need somebody local to handle that. So that's why we have people locally, yeah. So a lot of stuff, as long as, whether it's on the phone or on the back end software, is all that, they can all handle that, and they're great. And we've been using them for a long time. They're great, yeah. And also they work US hour, right? There are people that don't know about it. They actually work US hour.
Yeah. You probably can work a full cycle, 24 hours, right? If there is maintenance calls, because in the Philippines, when it's daytime, it's nighttime here. I remember when LREOs actually had 3 shifts. I remember, we just stacked them. We had so many maintenance calls. That was back in 2010, 11. It was, where was a crash. We were managing hundreds and hundreds of homes. When they get foreclosed, they need to get prepared, trashed out, winterized. And when it's a winter, we used to be a mess here. Pipes are breaking in and flooding, and it was pretty much nonstop calls, all the time. So we had multiple shifts just to manage that whole operation.
So this is a trick I learned in the property management business. So we try to avoid properties in the Bay Area.
Yeah.
Because if the property in the Bay Area, the owner's cheap, the owner doesn't want us to spend money, and it's going to be a hassle for us. But the properties in a good area, the owner tend to be very responsive, and they're okay spending money, maintaining the property. It's a lot easier for us, and we can charge, reasonably better rates actually. So that's what we learned.
Makes sense. And that was great conversation. I really enjoyed it. I think people learned a lot. Where people can find you, and do you have any projects right now that you're raising money or you want to promote? A lot of people listening. So where can they find and what help do you need?
I'm just open to connecting with anybody, in the industry, right? It's all about the it's not transactional. It's all about the relationship and also the ecosystem. That's why we're doing this interview. Appreciate your time. Where people can find me, so they can call my work number, which is I think it's 949-391-6668. That's my work number, 949-391-668. Yeah, that's the correct number. They can text me, call me, or they can go to my website. It's connectedcompanies.com. My email is T as in Tony, C as in Charlie, so tc@connectedcompanies.com. That's how they can reach me. Oh, by the way, so I'm in LA area, right? So My office is just 10 minutes away from downtown LA. Anybody who needs property management service and construction service, they can always reach out to me. I'll just happy to connect with anything.
Awesome. Thank you, Tim. Yeah, and if you have any good deal in LA, please send it to Tim, and he's gonna figure out how to make the deal happen. So thank you very much,
Yeah,
guys.
for sure. Yeah, I hope you buy stuff over here and just keep it forever.
Awesome. All right, thank you. I really appreciate, and we'll hopefully do another one soon.
Thank you for your time.
You've been listening to the Value Builder podcast. For more strategies, stories, and episodes, head to valuebuilder.co or subscribe on your favorite app. Always make it better than you found it and keep adding value. See you in the next one.